Well, holy flippity flip flop flapping smokes, everyone. The market's worst fear has finally been confirmed, the moment we have all been waiting for, what we've been trying to warn people about on the channel here. The yield curve, but the most significant part of the yield curve, the 2-year treasury yield and a 10-year treasury yield has finally inverted. This is one of the most reliable indicators that predicts if a recession is going to come. So people, we need to dive into the data, we need to dive into the news, and we need to learn from history to see what exactly is going to happen in the markets moving ahead and how we can position our portfolios to potentially make some money. So everyone, let's not waste any time. Let's get straight into the news, the facts, and the data. Well, by flipping crikey, everyone, look at this 2-year treasury yield tops 10-year rate, a yield curve inversion that could signal a recession. So what this bond market phenomenon means is the 2-year treasury yield, that's the 2-year IOU from the government. The government issues debt, IOUs, bonds, treasuries, okay? And then they have to pay interest on that. Now, normally what happens with the 2-year treasury yield is that is highly reflective of what the rates are going to be for the Federal Reserve going ahead. But longer treasuries like the 10-year and the 30-year predict what rates will be longer down the road. Now, why investors and hedge funds pay so much attention to this is because this is one of the most reliable indicators to predict a recession. Now, the last time this happened was in 2019, right before we saw the steepest and fastest economic slowdown in history in 2020. So everyone, let's hit the charts. Okay, so as I'm recording this, the 2-year treasury note is 2.343%. And the 10-year, everyone, it is 2.339%. So what that means, everyone, the US 2-year and the 10-year spread is still in negative and still in inversion. And the markets definitely didn't like this today. The algorithm sold off in the last hour at the close, which confirmed the worst quarter for the stock market in 2 years. The Dow was down 550 points, the S&P was down around 1.5%, and the Nasdaq was down around 1.5% as well. But exactly how likely is a recession? Well, when we look at history, there is 2/3 chance of a recession in the next year, but there's a 98% chance of recession in the next 2 years. So what this is telling us, everyone, we need to start preparing right now before it is too late, which I'll get into later in the video. Now, why the spread between the 2-year and 10-year treasury yield is also so important for the banks and for the economy is because if the banks take this money and that's their cost of borrowing, but then they only get a certain percentage or a lower yield for actually lending it out over a longer period of time, well, simply, if they can't make money lending, well, then we're going to see a credit freeze. And we all know this economy relies on debt, and especially the housing market relies on debt. So if the banks can't make money from lending and they stop lending, that's when we'll see real economic pain coming ahead. But it's not just the yield curve we have to watch. We also have to watch what happens with employment. Right now, employment is very strong. So for us to see a painful recession, we're going to have to see the unemployment rate go up. Also, we're going to have to see the service sector slow. And we're going to have to see manufacturing drop as well. And as we can see here, people, the US service sector did slow in February. The Institute for Supply Management said on Thursday its non-manufacturing activity index fell to 56.5 last month, the lowest reading since February 2021, from 59.9 in January. Look at the manufacturing data right now, like employment is still good. The S&P Global US Manufacturing PMI increased to 58.5 in March of 2022 from 57.3 in February, easily beating forecasts of 56.3. It was the highest reading since September 2020, with output rising at its fastest rate since last June. But also what we have to look at what happens with manufacturing, because let's be honest, most of it happens in China. We have to see what is happening with manufacturing over there. China's manufacturing services contract together for the first time since 2020. The official Manufacturing Purchases Manager Index PMI fell to 59.5 from 50.2 in February, the National Bureau of Statistics NBS said on Thursday, while non-manufacturing PMI eased to 48.4 from 51.6 in February. And this is obviously due to the latest lockdowns in China and Shanghai, and also consumer sentiment falling in China as well. Now, we also have to look at both sides of the story here, people. What could reverse the yield curve is if all of a sudden we see a resolution, or we see the war end with Russia and Ukraine, and we see commodity prices go down, and we start to see trade pick up, because it's looking very, very likely that Europe is going to enter into a painful recession with gas and fuel and energy prices rising to record levels. Also, if we do enter a recession and the Federal Reserve does a massive U-turn and starts lowering interest rates and does QE infinity like they did in 2020, or even does negative interest rates, starts doing yield curve control like they did here in Australia with the RBA, that's where a central bank buys unlimited amount of treasuries like what the Central Bank of Japan is doing right now. But again, in order for us to have a good idea what may happen in the future, let's learn from history to see what happened the last time the yield curve inverted. According to UFG Securities, the yield curve inverted 422 days ahead of the 2001 recession, 571 days ahead of the 2007 to 2009 recession, and 163 days before the 2020 recession. So the good news here, people, if you heed my warning now, you have time to prepare. But if you be like what most average Americans do, they don't do anything. They say, oh, this is all doom and gloom, and they wait till the actual recession is announced, because remember, we could be in a recession right now, but we won't know it until we get the data of 2 consecutive quarters of GDP contraction. But what you have to know is the economy and the markets are 2 different things. When we had the steepest contraction in GDP growth on record, we saw the markets skyrocket to record highs. So let's have a look at history again to see what normally happens with stock market returns after the yield inverts. Well, look at this, everyone. Let's go back to 1988. From the date of the inversion to the date of the bull market peak of 1990, the S&P 500 index returned 33.2%. So it was 19 months to the market peak. The following yield curve inversion was in 1998, and the bull market peaked in 2000, and that saw a 39.6% stock market return and 22 months until the market peaked. In 2005, when the yield curve inverted and the bull market peaked in 2007, the S&P 500 saw a 24.6% return, and it was 21 months until the market peaked. And the most recent one, 2019 to 2020, the S&P 500 returned 18%, and it was 5.8 months until the market peak. So again, going off the averages and going off history, market actually performed very strongly after the yield curve inversion, returning an average of 28%, and the market peaked on average 17 months later. Now again, historic returns are no guarantee of future returns, but what this data says is we still may have some great gains in the stock market for the following 12 to 18 months. Bond market veterans are now saying is they're now saying this is not a reliable indicator anymore, because the Federal Reserve has taken over the bond market, and the Federal Reserve actually owns most of the 10-year and the 30-year US Treasury yields. So they're artificially keeping these yields low when they should be much higher. In fact, Richard Burstein Associates notes that if the Fed had never engaged in quantitative easing, the 10-year yield would be close to 3.7%. The 2 years skyrocketed is because it's most relative to the Federal Reserve rate hike cycle. And the reason why the 10-year US Treasury yield has been suppressed is because we've seen investors pile into so-called safe haven assets like the 10-year US Treasury with what's going on with Russia and Ukraine. But everyone, I'm sure what you're wanting to know is, what does all this economic jargon mean for me in simple terms? What this means is it is more likely than not, when we look at the historic data, that we are entering recession. But what this could mean for us investors is this could be a good buy the dip opportunity. Also, if you're going to buy the dip, you can get up to 5 free stocks with Moomoo for when you deposit $100. Link in the description. Because people, I don't want to be biased on this channel, so the Federal Reserve does do a U-turn, and we look at the historic data, what happens to the stock market after a yield curve inversion, we could have good times over the next 12 months of returns of 18% plus. And over the next 18 months, we could see an average return of what happened historically of 28%. But everyone, this is just an average bloke YouTuber's opinion. What do you think? Let me know. Thanks for watching. I'll see you all in the next video.